Welcome to Stock Talks with Akash. Follow this channel to create a money mindset.
Hey, hi there. Welcome back to my channel. And today we'll be discussing all about what is EBITDA, how to calculate it, and how to interpret it, where to use it and where not to use it. Okay, so let's get started. So, EBITDA, let's see what it is. EBITDA. It is the core earnings of the company. Okay, the core earnings that is generated from the business is EBITDA. Okay, now let's see how can we calculate it. So it is earnings is net profit plus interest, earnings before interest plus tax plus depreciation plus amortization. Okay, so that is how you calculate it. There is another formula. By the way, if you club these three, it is EBIT. Okay, this is called operating profit. So operating profit plus what I and T has already came. What is left? Depreciation and amortization. That is also one of the formulas. It's more or less the same. Now, another way to calculate it is revenue minus operating expenses. Of course, please excluding depreciation and amortization. Okay, that is how you calculate it. So let's take a real example and I will show you how it is done. Okay, so let's quickly go to the browser and let's show you a real life example. How do we calculate it? So we are calculating it for Anant Raj Ltd. This is a stock which I am right now evaluating, so why not? So EBITDA is not given on screeners, however you can calculate it. You have enterprise value given, you have EV EBITDA given, you just have to find out EBITDA. Okay, value of X, very easy. You have to divide this by this to get EBITDA, which I have done already. 19,526 divided by 33.7, which comes out to be 579.4, near about 580 crores. Okay, it's in crores, so crores, which I've written it over here. So EBITDA already calculated, you just have to tweak a little bit in screener and EBITDA is there. Now how can you calculate it by yourself? So for that you have to go into the profit and loss statement. I'm very familiar with Tijori because it's my broker's website, so I will use that to showcase you. So we will go to the financials and we will go to the profit and loss. Okay, Let me show you first is this one, revenue minus operating expense. Okay, so what is revenue? Revenue is nothing but the sales. 2181 crores minus 1641 crores, which I've done it already. 2181 minus 16, it comes out to 540. Okay, so why there is a 40 rupees gap, for not 40 rupees, I'm sorry, 40 crores gap, is because uh, there is other source of incomes as well, so you have to include it in the sales, which I have done, which I've added over here. Comes out to be 580, near about exactly matching. Now the another formula over here which we have discussed, net profit plus interest plus tax plus depreciation and plus amortization. Okay, let's do it. Where is net profit? Over here. All the figures you have to take it from here. Net profit for 457 crores, which is mentioned over here. 457. Tax is 80. Here's tax over here, 80. Interest, where is 9.78. Interest 9.78. Depreciation amortization figure 32.89. Okay, simple sum, add all of this, 580, which matches exactly which is what is given on the screen. So EBITDA is 580 for Anant Raj Limited. I hope you get it, how to calculate it yourself. However, how to get it from the screener as well with a very little effort. Okay. Okay, now let's dive into the interpretation part. Let's quickly go to the notes section, and I've written the EBITDA here that we have just calculated and its individual items. Now let's see how can we interpret it. It is very easy and very intuitive as well. It's the earnings. Of course, it is the more the better. The more the better. It should always increase year over year. Okay. Now the third one, the earnings should always be maximum. The individual line items should be less than the earnings. Of course, you have to earn more and pay less taxes, less interest, and the depreciation and amortization, it as per the company fluctuates. However, generally earnings should be the maximum part of your EBITDA. Now, the intelligent investor always thinks that the interest part is actually your earnings. Why is that the case? So, the intelligent investor thinks that one day or the other that the company will pay off its debt, and the money that it is currently paying as an interest will come to its earnings. So please be mindful about that while you are selecting the company. Now this point brings us to the case where it is mostly used. Mostly used, for pardon me of my handwriting, is to compare companies excluding the noise. The noise, by noise what I mean, in which country you operate, country, city, Where do you operate? What is the capital structure? If you have you raised any debt, do you have any loans or that thing? So we exclude all of these things and add to the company and then see which company is more efficient in generating the profits. Okay, this is where the EBITDA is mostly used. And let me just tell you the caveats as well, where it is not used. Where it is not used. It is generally not used in the banks or NBFCs. Why? Because in banks and NBFC, interest is the major portion of the income. And in EBITDA, it is not included in the income. So earnings is a separate component and interest is a separate component in EBITDA. Whereas in banks, the interest component is the earning component. So it doesn't make any sense in banks. The second is where it is generally not used is the capital intensive industries. Capital intensive industries. Why is that the case? Because in capital intensive industry, generally the depreciation and amortization cost is substantial. Is substantial. And it gives you an inflated earnings. Inflated earnings. So it does not give you the true picture. Maybe the depreciation and amortization cost that you're seeing, it has already been spent by the company, and that is, it is separately shown. It's not the earnings, it's just the accounting entry. So it gives you an overinflated picture of the company. So that's all about EBITDA. Let me just quickly recap what we have learned. Okay, so EBITDA, what is EBITDA? EBITDA is the core earnings of the company, the core profit. It includes the tax, it includes the interest, it includes the depreciation and amortization cost. Adding all up is the EBITDA. The other one is revenue minus the operating cost. It's both one and the same things. We have seen the interpretation part, how to interpret it. Of course, the more the better. Always it should be in an increasing manner. Earnings should be the major portion of the EBITDA, right? It is mostly used to compare company by separating the noise about in which city they operate, in which country they operate, or what's the capital structure all about. And it also excludes the accounting, gimmicks and all. And where it is not used at all, it's in the banks, because interest is the major portion which it shows separately. Next is the capital intensive industry, where the depreciation and amortization cost is substantial and it gives you an inaccurate picture of the company. So that's all about EBITDA. I hope you like it. We'll be using this EBITDA in our next video by EV/EBITDA multiple. So stay tuned to my channel. I hope you like it. I will see you around in the next video. Bye bye.
Disclaimer: the information provided is for educational and informational purposes only and should not be considered financial or investment advice. I am not a SEBI registered investment advisor or research analyst. Investing in stocks involves risk, including the potential loss of principal. Always conduct your own research and consult with a qualified financial advisor before making any investment decision. Past performance is not an indicator of future results, and all investment carry inherent uncertainties. The author and associated parties are not responsible for any financial losses resulting from the decision based on this information. This channel does not promote any form of current returns or insider tips. Always invest responsibly. Thank you.